Yo, what is up, Tukhi trading family? Hope you guys are well. Happy Thursday or whatever day you're watching this video. For today's video, masterclass day 4. We are going to be covering fair value gaps. There's going to be two parts to, the fair value gap. For the first part, which is going to be for today's video, I'm going to be covering what fair value gaps are, how you can spot them within the markets, and then going on into tomorrow's lesson, which is going to be the part 2 of the fair value gaps. I'm going to be going over how you can actually trade them, where you should put your stop loss, your entries, and stuff like that when you are using fair value gaps. So let's go ahead and hop right into it and get things started. So like I mentioned, for today's video, I mainly want to cover what fair value gaps are exactly before we actually dive into me going over how to trade them. You're probably already familiar with the term fair value gap. If not, this video is going to be perfect for you. And this is pretty much, the reason why I'm making this video. So you guys can better understand fair value gaps and better understand how to use them to your advantage. Because you guys probably hear me talk about it every single day in pre-market review, live trading, whatever. It's because I use them every single day and they're very useful. So I want to make sure that you guys are very comfortable with them as well moving forward. So let's go ahead and get on into the slideshow. Fair value gaps. So what exactly are fair value gaps? Fair value gaps are inefficiencies or imbalances within the markets. These gaps or imbalances typically tell us that buying or selling pressure within that move that we just had was greater than usual. So keep in mind, we constantly have buying and constantly have selling going into the market. But when buying or selling is stronger than usual, that typically is what creates fair value gaps. It's typically what creates demand or supply levels, key levels like that, when buying or selling is greater than usual. So keep that in mind. Moving on, like I mentioned, within these imbalances or gaps, unfilled orders are left within that gap, causing market to typically retrace back to that area and fill those unfilled orders, fill that imbalance, right? Because in order for market to make the next move to where it wants to move to next, it needs to make sure that the gaps, the imbalances / unfilled orders within that area are filled. And that's exactly how fair value gaps work, is due to the fact that the gap is what creates an imbalance, and within that imbalance is where unfilled orders are left, and also where that imbalance area wants to get filled, right? So moving on. Why do fair value gaps work? The market typically shifts towards these value to fill these gaps and regain its balance, just how I mentioned in the last slide, right? So obviously market is typically going to shift back towards these gaps, shift back towards these areas of value, which is the imbalance / fair value gap, and regain its balance. And the way that it can regain its balance is by filling that gap / filling those unfilled orders. Keep in mind, orders are just money. So when money is moving into the market, especially a large amount of it in one area, that's going to cause a large push from that area, right? That's typically why we mark out those fair value gap areas. Moving on. Usually we see bounces / reversals based on the type of fair value gap that there is when tapping into fair value gaps from the unfilled orders / imbalance being filled, just how I mentioned. And you probably heard me just say, different fair value gaps. There are 2 different fair value gaps that we can utilize and trade, and that's going to be our bullish fair value gaps, and that's typically when buying pressure is inputted and is greater than usual and then creates that gap, or vice versa. Then selling pressure is greater than usual and then creates that gap to the downside. That would be a bearish fair value gap. So obviously we have 2 types of fair value gaps. Our bullish ones typically kind of treated like demand zones, but they work a little bit differently. And then our bearish fair value gaps treated like supply zones, but keep in mind they work differently, right? They have a different concept of how they actually work. How do we actually find fair value gaps? So fair value gaps can usually consist of 3 high momentum candles. When you see a gap within the first and the third candle, you want to mark out the top of the first candle to the bottom of the third candle. This is what forms a bullish fair value gap, and I'll show you guys an example of exactly what I mean on the charts very shortly. But moving on to just the last slide within the slideshow was what are some time frames that you should chart out fair value gaps on, right? Because like I mentioned, the gaps are pretty much imbalances, areas that the market wants to regain its value from. So typically we want to mark out those areas. So what time frames should we mark those areas out from? You can do it from many different time frames. I'm sure everyone is different, but the ones that I had marked out with a star next to them are the time frames that I personally use the most and that I see the most success with when drawing fair value gaps. So the 1 minute, 5 minute, and then 30 minute. So let's hop on into the charts and then get things started. So let's start with a bullish fair value gap. Typically, like I mentioned, the bullish fair value gaps, or not just the bullish and bearish fair value gaps are typically going to consist of a 3-candle pattern or a 3-candle move. So in this case scenario, you can see we have a 1, 2, 3 candle move to the upside, or you can do 1, 2, 3, right? But for this one, we're going to do 1, 2, 3 for this candle pattern. And what I want to show you guys before we draw out the fair value gap is keep in mind that when we have candles typically trading next to each other, we pretty much always have the candles, the highs and the lows of the candles always touching each other, always overlapping each other, right? You can always see that the candles trading next to each other, the next candle opens, it's trading next to each other, overlapping on each other. But in this move right here, you can see that this first candle and this third candle are not touching each other. You can see that there's a simple gap between this 3-candle move. You can see that this large, not large, but you guys can see it's a noticeable gap within that 3-candle move, and the candles aren't overlapping. So this is how bullish fair value gaps are created. You can also see that, like I mentioned, bullish fair value gaps are created when buying pressure is greater than usual. You guys can obviously see on this strong move up, we had strong buying. So what we want to do is we want to mark out the top of the first candle and connect it to the top of the third candle. So get our rectangle out, our box out, mark the top of the first candle to the bottom of the third candle, and then we're going to want to extend this out. Now keep in mind, when I'm using my fair value gaps, typically I'm only looking to enter off the first retracement. Yes, we can see multiple reversals or bounces from fair value gaps, but typically I always want to focus on the first one. And if I am entering, I want to enter on the first bounce or the first reversal, right? Because that's initially what's going to be the strongest, because when market or when price shifts back to that fair value gap, like I mentioned, it has an imbalance in unfilled orders left within that area. So the first time is when the most amount of imbalance / unfilled orders are left within that area. The first time, right? So obviously the first time it retraces into it, that's what's going to cause a stronger move. So that's typically why I only look to enter, or why I only really look to utilize a fair value gap on the first move. So you guys can obviously see we have the fair value gap created. Market does its thing, and you can see the candles do its thing, and then we finally retrace back into this fair value gap. Now you can see price starts to hold this fair value gap very well, and you can see that price starts to reverse and reject this fair value gap and start to push up to the upside. And you can see how strong buyers start to step in and pushing price to the upside, right? Just simply off this fair value gap. The reason for that was because, like I mentioned, we have an imbalance created here. And on this imbalance, typically unfilled orders too are left within this area, left within this imbalance. So market's going to want to shift towards this imbalance, fill this imbalance, fill the unfilled orders that were left within that area, and obviously push price up. And the reason that unfilled orders were left within this area is due to the fact that since price moved too fast, market makers didn't have time to completely fill their whole positions, meaning that certain orders were left on the plates pretty much. And that's where the fair value gap is. So you can see that. And then another example of the fair value gap being created, I'm sure you guys can already see, but we have a nice 3 candle move to the upside. So another example of a bearish fair value gap would be, like I mentioned earlier, we want to mark out the top of the first candle to the bottom of the third candle and simply just extend it out. And then we want to simply wait for a retracement, which is pretty much we got instantly or shortly after. We had a bounce into that fair value gap. Price also started to hold this fair value gap very well, and we pretty much saw the same exact thing that happened from this fair value gap. We bounced, we held, we rejected, and we reversed back to the upside due to the amount of buy orders that were starting to be inputted, right? And then you can also see we had a slight bounce again, but typically, like I mentioned, I only want to look for the first retracement. Whether that's me entering, whether that's me using the fair value gap to understand where price is going to continue moving to, or if it's for like my exit, whatever the case may be, I only want to make sure that I'm using the fair value gap on the first retracement, sometimes even second, but realistically the first is going to be stronger. When it does present you that move, the first is going to be stronger. So that's going to be that. So those are going to be our bullish fair value gaps, right? Now we want to focus on our bearish fair value gaps because, like I mentioned, there's going to be two different fair value gaps. And fair value gaps aren't obviously going to work 100% of the time, but they are going to be very accurate and they're going to be very effective, and you're going to notice and realize that once you start to use them. But you have to use them correctly, and you have to understand how to trade them correctly. So obviously, I will be covering how to actually trade these fair value gaps going into tomorrow's lesson. But for today's lesson, like I mentioned, I just want to kind of go over what the gaps are and how we can draw them out. So now that we have this out, we can see another 3 candle move, 1, 2, 3 candle move to the downside. So what I want to do, keep in mind, guys, I've been doing all of this analysis on the 1 minute. What I want to do now is instead we're going to do it a little bit differently for the bearish fair value gap. Since they push to the downside rather than they push to the upside, it's a gap being created to the downside. So we want to mark out the bottom of the first candle and connect it to the top of the third candle, right? And this is what creates a bearish fair value gap. Same exact concept from what I've been mentioning from a bullish fair value gap. Obviously, instead of buying orders, instead of buying pressure, it's sell orders / selling pressure. Now you can obviously see this gap is created. Price does its thing. It retraces into this fair value gap, and pretty much on the first retracement, I'm going to extend it out a little bit more. You can see on the first retracement, we have a strong push to the downside. Pretty much this candle right here, you guys can see how strong selling pressure was right there, obviously due to the fact that this imbalance was being filled, and this unfilled selling orders that were left within that area were then starting to be filled, meaning money was starting to be put within the market. Lots of money was starting to be put within the market within this area. That's why we marked out that area, because that area was a zone that we were expecting for lots of orders to start to come in. That's exactly what happened on this initial move to the downside. Like I mentioned, we typically only want to look for the first retracement, but you can see price did actually shift back towards this fair value gap here. We held it very well. We respected it very well. We also had a nice push to the downside here, but like I mentioned, we really only want to focus on the first move. But you can see here we had a strong small push to the downside right into this bullish fair value gap, like I was showing you guys earlier. So we had a small push to the downside into the bullish fair value gap, and right when we tapped the bullish fair value gap, we held it very well. We started rejecting from it very well, started showing buying pressure, and initially started to push very strong to the upside, right? Very, very strong, right? So that would be that, and then that would be how we would draw out a bearish fair value gap. Now, let's see here. Now, if we were to do, let's say we were to do something like this. So we see we can either do 1, 2, 3, or we can do 1, 2, 3. Typically what I look for is I look for the biggest move, the bigger moves, or the bigger gaps, because that typically means that there's a larger imbalance to be filled. So right here initially we see 1 strong candle, which is the main gap, the main move, and then 3. So we're going to mark out the bottom of the first candle, connect it to the top of the third candle. Now you can see price pretty much instantly retraced into our fair value gap. We had a strong push up into the fair value gap. We held this fair value gap very, very well and started to initially reject back to the downside from the amount of selling orders that were starting to come in. And you can see from this fair value gap, we had a strong push back to the downside. And then pretty much, let's see, same thing, right? Could we do this as an example? 1, 2, 3, would that invalidate it? Now here's this. I just want to show you guys because I've been showing you guys only working examples. So let's say we do something like this. 3 candle move to the downside. Obviously we see a gap being filled right here. And just to kind of clear it up, we see the first candle here does not connect to the third candle here. You can obviously see a noticeable gap. I'll show you if I even draw out the lines. You can see mark right here and then mark out right here. You can see there's a gap between both of these candles, as if I were to do something like the top of this one and bottom of this one. You can see it still overlaps, right? You get what I mean? So, or something like this, like top of this one and then bottom of this one. So you can see there's no gap really being created here. You can see all the candles are overlapping over each other. The wicks are always touching each other somehow. But right here, you can see this candle right here is not touching this candle right here. And that's what creates the imbalance. That's what creates the gap. So if we were to draw that out, boom, boom, and then extend it out, we can see that price initially held this level very well, started to show signs of selling pressure, but initially pushed back up. Now, obviously, we can see that buying pressure was simply just way too strong here, and price or buyers simply didn't want to give up their position and being, you know, the overloader here. So obviously, we can see price pushed up and validated this fair value gap, but I believe we actually tapped into another fair value gap, and that's what actually provided us with this initial move here, with this initial strong push to the downside. So it looks like, and I'll be covering this in tomorrow's lesson, but it looks like that fair value gap just simply wasn't the best gap to enter off of. So tomorrow I'll be, you know, covering how to actually enter off of the best gaps, or how to actually, you know, find confirmations to enter off of the gaps. But in the meantime, let's do this fair value gap to here. So we can see this is even a small gap, right? Some fair value gaps are going to be wider than others, but if we extend this out, you can see it tapped into this fair value gap, held it very well, rejected from it very well. And like I said, that's initially what caused this strong push, strong move to the downside, was this fair value gap rejection, right? It didn't just reject for no reason. It didn't just reject at any random point. It tapped into the fair value gap here due to the fact that there was an imbalance / unfilled orders that needed to be filled, and started to push back to the downside. So that's going to be a quick example of how we can draw out our bearish fair value gaps and also our bullish fair value gaps. And then if I switch over to the 5 minutes, because I know I showed you guys how we can draw out fair value gaps on different time frames, it would pretty much be the same exact thing. Let me go ahead and I'll just do something like this. So we can see initially 1, 2, 3, 3 candle move to the upside, 3 candle push to the upside, and we can also see a gap right here. This candle is not touching this candle all the way up here whatsoever. You guys can see, this candle right here whatsoever, right? You can see it's a pretty noticeable gap, pretty noticeable space. So what we want to do is mark out that gap. For the bullish fair value gap, we want to mark out the top of the first candle to the bottom of the third candle, extend it out. And you can see on the 5 minute, it rejected this fair value gap very well, held this fair value gap very well. It did show signs of selling pressure to want to break below, but you can see those buyers just simply did not give up this level, and this fair value gap was heavily respected, and you can see this initial strong push to the upside off of this fair value gap. Market even closed right here, but you can still see price still continued to do its thing and work its magic off of that fair value gap once market closed. Strong push to the upside here, strong push to the upside here, all simply off that fair value gap. So that was the 5-minute time frame. You can mark your fair value gaps out on multiple different time frames. I do recommend drawing them out on multiple different time frames, because when you can and when they do match out, then that gives you more confirmation. Let's say you draw a fair value gap on the 5-minute time frame and then you draw it out on the 1-minute time frame too. Let's say both of those gaps on different time frames are showing up within the same area. That should really confirm to you that that area is where either the buyers or sellers are going to want to take advantage of to fill that imbalance to either the up or to the downside. So that's another tip as well, is drawing the fair value gaps on other than just the 1 minute. Matching them on the 5-minute, matching them on the 30-minute. If you can't find a fair value gap on the 1 minute, find it on the 5-minute. If you can't find it on the 5-minute, find it on the 1 or 30-minute, vice versa. But obviously, like I just mentioned earlier, if you can match the fair value gaps out on multiple different time frames and the fair value gaps come out to all be in the same area, that should be a very, very strong confirmation to you. But other than that, this is going to wrap up today's lesson, Masterclass Day 4. Tomorrow's lesson will be Fair Value Gaps Part 2, so I'll be covering how we can actually use fair value gaps to take trades, how we can utilize them for our take profit levels, exit levels, different stuff like that. More advanced stuff diving into fair value gaps, but this was just covering how we can spot them, how we can draw them out, etc., etc. You guys get the idea. Other than that, if you guys have any questions, DM me on Discord or just, mention me in general chat. Other than that, much love. I'll see you guys in next lesson or the YouTube live or the pre-market review or whatever it is. I'll see you guys next time. Take it easy.